Welcome to CFO Chat. This is your front row seat with the CFO. Anytime a corporate action has taken place, you have all the details here. And EABL has released full year numbers for F23. As always, we are privileged and delighted to have Risper Genga Ohaga. Thank you so much for your time.
Thank you, Julian.
Risper, we sat almost in this very place 6 months ago, and looking at the numbers you've released now on a full year basis, it almost feels as though H1 and H2 are from two fundamentally different accounting periods. Quite some hits on H2. Maybe just begin by giving us some context around the operating environment.
So the operating environment in H2, as you say, has been a completely different dynamic from H1. A few fronts. One, inflation. Inflation really peaked across all the markets. And when you look at our inputs, ethanol was scarce throughout H2, and that started late in H1 and peaked in H2. And we're having to now source ethanol at 60% above what we were buying before. So there's like a 61% inflation on ethanol. Grain is almost 31% following the drought. Glass, following the excise increments, we're buying that at 20% above. And, you know, that follows transport and logistics, electricity, 40%. So you can see that just from an inflation perspective, we've seen immense pressures come through. And I think all the consumers are feeling this across our countries. The second thing is currency depreciation. We've seen very, very quick depreciation of the shilling, closing at 142 there. We'd started off at about 117, and so that's about 18-19% depreciation, most of it in half two. And at the beginning of the year, you will recall us talking about a 1.8 billion position on FX exposure because we just weren't getting access to foreign currency. We were able to access foreign currency, fortunately within half two, but that meant that we extinguished that position. But also when you consider that with scarcity of materials, you're importing more, then the FX hits are bigger. So we do have about a 2.1 billion hit on FX in those numbers. The third thing is just, again, the macros across East Africa and specifically in Kenya with the inflation coming through. Consumers are under a lot of pressure, and so they're having to pick and choose where to put their money. And so we've seen a volume drop of 7%, mostly on beer, on account of just the pressure consumers are under, and the fact that we had also gotten another excise increase in October on top of the June excise increase. So we took price again for that, and that has seen volumes decline as consumers just can't keep up with such drastic increases in excise. So those are the main drivers, I think, that you will see facing us in half two, a combination of inflation, currency depreciation, the impact of the excise increase, and the consumers just under a lot of pressure given the macros.
On the FX depreciation, Risper, and just to echo what you mentioned in the briefing, thankfully you don't have FX exposure now on your balance sheet side. Maybe speak to that, please.
Yes, we were fortunate that with the improvements in the FX policy area, we're able to access FX and extinguish that position. However, I think we cannot say we are out of the woods in terms of FX, because as I say, with scarcity of raw materials, whenever we import, we have to access FX, and with continued depreciation, we'll continue to face exposure to FX. Luckily, the availability means that we can access the FX when we need it, and now we actually are in a positive FX position, and we're able to pay our suppliers as and when we purchase.
I see. Risper, looking at your P&L, whereas we must congratulate you for stellar profits, I think second highest since F19, I couldn't escape the notice that EABL, and considering the bellwether that EABL is in this market, was 400 bips shy of a profit warning on a full year perspective. How do you feel about that?
Well, I think it's not unusual. We are not in this company on our own. We have seen a number of companies as they report, maybe other than the banks, you are seeing a decline in profitability in the range of the 20s. So it's not unusual at all. But having said that, you know, it just is reflective of what we're all going through and the pressures we're facing given the tough economic environment.
Okay. And looking at the portfolio, and one of the bright spots which was highlighted this morning is winning in premium. And of course, when you look back, whereas we're talking about 5% up year on year, if you go to F22, it was up 27% thereabout. If you go to F19, it was up 54%. Just how much runway do you think this particular portfolio has before it feels the pressure that the rest are feeling?
I think there's definitely a market, and it's a market that has proved to be resilient. And if you look at our strategy, we started out on that winning in premium about F19. And so that growth, having started on that journey, just reflects how much we've invested behind those brands and the identification. First, you can create the market and then you can supply it. So we've done a pretty good job of doing that across our markets. So in Kenya, the growth in premium on the spirit side is in the 20s. 24% in Kenya. In Tanzania, again, we've seen great progress with that, going up to almost 18%. In Uganda, it's a bit of a mixed bag. We've not seen as much growth, but again, it's an area of focus for us. But the premium portfolio still remains small in our portfolio, and we think there's still opportunity. We see players from other bigger markets coming into this market, which tells you that there's still a sizable opportunity for us to build out that category. So I think there's still room for us to do more in that space, and it's a big part of our innovation, both on the beer side and the premium spirit side.
Okay. And looking at the regulatory environment, let's start from here. The excise on bottles, I'm just curious as to what sort of a dent in terms of the impact that you felt in the numbers we've just seen.
Well, it's huge. It's, I would estimate between $500 million and $1 billion because it's an additional 25% which you can't claim back. Because most of our inputs we can claim back from a VAT perspective. Now this one we haven't been able to claim back. And in a space where the market is not able to supply all the bottles that we need, we're only importing not because we don't want to use a local, it's just because the market can't meet the need. Then, you know, such a tax is not very helpful unless there's concerted effort to build local production. So I think we're keen on seeing whether we can get more locally, and if we do get that, then that would alleviate the situation.
And still on the regulatory environment, for the first time in a long time, we've had the Finance Act, never mind, it's now a court, subject to a court process, giving a breather to alcoholic beverage. And I know whereas in the briefing it has been indicated we don't expect significant changes in the macro environment in F24, I'm just curious, to what extent do you think then this gives you a tailwind as you go forward?
I think it's definitely positive news. I have said before that the continuous excise increases were making us uncompetitive as a market compared to other countries. So when you came to do business in Kenya, you don't know when the excise will hit you, sometimes once a year, sometimes twice a year, but certainly every year. And getting some policy consistency is really important. When you look at Tanzania, they've now pronounced themselves that the excise increase will be only every 3 years. When you look at Uganda, they're also equally clear, and they don't have these increases that we do have here. And Tanzania before this year had not increased for 7 years. So you can see with an annual inflationary increase, we are running ourselves out of competitiveness really quickly. So I think as a country, it's a positive thing as a destination to invest, and for our products also to be competitive in pricing terms. It also allows the consumer to, as their income grows, then they have more disposable income, and then affordability becomes not such a big issue as it is now. So we certainly see some positivity to that. I think there reaches a point where the continuous increases become counterproductive. The law of diminishing return quickly checks in, and I think the policymakers have finally been able to see that.
Good point there. We've been having this conversation on the Laffer curve and where we potentially could be. Risper, the subject of the dividend always emerges in earnings, and particularly in this one. Whereas, I mean, when you look at the P&L, you can see the hit that has been taken. If you look at the cash position, I think it still looks fairly good. I think reducing by half, rather, the dividend looks like quite a drastic decision on your part. Yeah.
Julian, the first thing I will say, and I said it earlier, is that we run this business as owners. And so we do the right things for the business for the long term. So when we looked at this dividend decision, we put ourselves in the shareholders' shoes and say, what's the right thing to do? because you don't want to do something that today is going to be good and then tomorrow you've got problems. And so when looking at our dividend, we look at the policy, which we always intend to pay 70% of our profits. However, we consider what capex is in train. We also look at our debt ratios, which is what the board has given us as thresholds to manage the business. And this year, we are actually quite tight on our net debt to EBITDA ratio. And therefore, and even when we look at this volatility, we think it's the right time to conserve cash in the business, reduce the debt levels, and then, the shareholders will have a business that can give good returns for the long term. So we think it's the right thing to do. And directionally, I think for a discerning shareholder like the ones you're speaking to, I know they will see the benefit of what we've done.
Fair point there, Risper. One of the issues whenever I look at EABL numbers, and I've raised this before, is on the current ratio, always trending in the 0.8% horizon, 0.8 rather horizon, now coming at 1.04. Maybe just give us an understanding around the journey getting to this point.
Well, the journey has been on for literally since the COVID period, when not just the current ratio, but the net debt was quite high as well. And we looked at our funding structure and we asked ourselves whether it was optimal, and also whether not just the structure of short and long term, but also the maturity profile. So we did some work around that, and the first stage was in going back into the market for the MTN on the maturity of the previous MTN we'd issued. And we secured 11 billion, which is at 12.75 in this rising interest rates times. That was a very good call on our part. It gives us certainty on interest, but also gives us longevity in terms of a maturity. So we looked again at anything we're now investing in, as well as a portfolio holding, and then we took some decisions around restructuring that debt portfolio so the maturity profile makes sense and it all doesn't come in one period and puts a lot of stress on the balance sheet. So that's the work we've done. You will see an increase in the long-term debt, just lengthening the tenor and the maturity profile so that it is more supportive towards the current ratio. So I think we've done that. We're now just making sure that our operating cash conversion is very high. Our generation of free cash flows is extremely vital. And that's what we now want to make sure we focus on to help us to sustain that ratio above the level of 1.
I see. And still on the funding structure, people you speak to, businesses you talk to right now, the challenges in the loan repricing that is happening in this market. Yields, as you rightly pointed out, are quite elevated. Just curious as to how you are positioning yourself, especially from a borrowing side, given the sort of pressures we are facing in the market.
Yeah, well, it is a tough one because one of the things we felt was important, particularly from a current ratio perspective, was to lengthen the tenor. And in lengthening the tenor in a rising interest environment, you do have an interest rate risk involved there. So that's one of the things we looked at. We looked at the possibility of going for fixed rate. The premiums were way too high. And we just couldn't get the right balance of that. But then, as I said, we've been fortunate to have the 11 billion MTN sitting on our balance sheet. We also have another facility that is fixed. And then we also make use of revolving credit, which is a useful tool because you only use it as and when you need it. And for a business like ours, if we manage our cash right, we should be able to deleverage. And I think that will be important in how we manage the interest cost element.
Okay. Let's wrap this up, Risper. Increasingly, Uganda looking like the brightest spot in terms of performance. And when we look at the capex, which has been reflected, I think, about 12 billion, the question always emerges, is it reflective of the fact that you're seeing what looks like a new pocket of opportunity which needs to be maximized in Uganda, potentially scale back on Kenya based on what we are seeing?
Well, definitely. So first of all, a lot of our capex is maintenance capex. So with a big plant in Kenya, they will get a lot. A lot of it is also returnable containers, so bottles and kegs. And again, with a big portion of our revenue that will go into Kenya. You will recall through COVID, we spent some time putting additional capacity in Uganda, and that is what is helping us to meet the needs. We've also put both for beer and spirits and ready to drink. So Uganda is in good space as far as capacity is concerned. I think there might be a little bit more coming that way, but we think we're in very good space as far as that is concerned. Similarly, in Tanzania, big market, big headroom to grow. We've just put in a new plant, so exciting times, I think, for Tanzania as well. Kenya, I think we're still confident in this market. I do believe that businesses go through ups and downs, and at the moment it's a tough time for Kenya, but it's still a big opportunity for growth, especially in selected spaces. So the premium end still doing very well, and we're continually alive to what's happening to our consumer, and that's what directs where we invest and where the returns will come from.
All right. And my final question, you took quite a hit from the cost of electricity. What saving measures are in place? What sort of breather did it give you in the period we're reviewing now?
Yeah, just from a total energy perspective, we had, again, during COVID, invested in biomass plants in Kenya, in both our plants in Kenya as well as in Uganda. And those plants have saved us from an energy perspective nearly 350 million Kenya shillings worth of energy as we moved away from HFO to biomass. But from an electricity perspective, we're in the middle of looking at an option for alternative sources of energy that are green, but also that are not quite as expensive as what we're currently getting on the grid. I think every business has to look at that option given the increases that we're having.